Today on InvestTalk, we talked about how to make sure you're safe even when your data is breached. We answered questions on RSPU, on CrowdStrike, on CNH. Then we ended off the day talking about recent flows and what that means for investors' expectations moving forward.
This is InvestTalk, independent thinking, shared success.
Now let's shift a little bit to something that I don't like, and that is a massive data breach with 2.9 billion with a B, records stolen. And as I'm sure many of you have heard, this was a significant cybersecurity incident that raised alarms all across the digital world. The company at the center of this breach is National Public Data. Yes, that is a real company name. It's based in Florida, and it's a background check provider. And they reportedly have been compromised in a major data breach implicating the personal information of billions of individuals from the US, the UK, and Canada. Now, a hacking group known as USDOD claims to have accessed and stolen an alarming volume of data, specifically personal records for approximately 2.9 billion people. The stolen data file is said to include a whopping 277.1 gigabytes of sensitive information. Now, what are we talking about? We're talking about comprehensive details such as names, addresses, histories of where they lived, relatives, social security numbers, dating back at least 3 decades. Now, this kind of information is certainly a goldmine for identity thieves and could lead to a surge in fraud if it falls into the wrong hands, which it appears it already has. Initially, this trove of data was put up for sale on the dark web for only $3.5 million. Kind of seems like a steal, if you ask me. But the situation kind of escalated a little bit when different versions of the data started appearing in different corners of the internet. In fact, it looks like the data has been released by some cyber criminals for free. Now, National Public Data, while not widely known outside of probably businesses who use them for background checks, I'd imagine, does play a significant role in the space. And keeping all this in mind, in light of everything that I've told you and that you've heard elsewhere, the question then becomes, what can you do if you suspect that your information might be compromised? Well, first and foremost, it's important to control what you can control. And so you want to ensure that your antivirus software is up to date. Conduct full security scans of all your devices to detect and try and mitigate any intrusions. You want to change your passwords immediately. Ensure that they are robust, unique across different sites, and include a mix of letters, numbers, symbols, avoiding anything that's easily guessable, like birthdays or anniversaries or your pet's birthdays or your pet's anniversaries. Where possible, activate multi-factor authentication. Some people use their phone. It's probably best to use third-party applications or use Google Authenticator. What that does is it adds an extra layer of security, making it harder for unauthorized users to gain access, even if they have your password. I get emails all the time from Microsoft of people in Russia trying to get into my Microsoft account. It's something that happens. And so having that multi-factor authentication adds an extra layer of protection. You also want to be extremely cautious about emails and messages that ask for any personal information. I got a call the other day from the Coinbase fraud department. I'm using air quotes, which you can't see if you're listening, talking about how my account, which does not exist, was compromised and that a representative would call me back. These are the types of things where they try and get additional information for you. And so this breach serves as a stark reminder of the ongoing vulnerabilities in digital data security and the importance of taking proactive steps to protect your personal information. Because at the end of the day, nobody is going to do it. You have to protect yourselves. So, in the digital age, vigilance is your first and best line of defense. Let's talk a little bit about the market today. U.S. stocks finished lower, though off of the worst levels of the day. The Dow down 15 basis points, S&P large caps down 20, NASDAQ down 33 basis points, Russell 2000 down 1.17%. Looks like the worst performers today included energy, semis, banks, particularly regional banks and investment banks as well. Not all due to the Twitter debt, I will say. Outperformers included pharma, did pretty well today. Networking communications companies, payment companies, managed care companies did well as well. Dollar index was down 50 basis points, gold up 40 basis points, and crude oil down 70 basis points. Weaker for the fifth straight session, or rather the fifth session of the past 6 weeks, I should say. Overall, I'd say the trading volume was pretty thin. It was pretty quiet. There was no specific catalyst behind what was more of a risk-off tone, certainly today, than the past couple days, though maybe some of it had to do with an 8% rise in the S&P in the prior 8 sessions, really approaching within 1% of July's record high. I think overall the market's continuing to wait for what Chair Powell says on Friday. You got to keep in mind, we got the big summit, the big annual summit of central bankers in Jackson Hole. And also NVIDIA earnings next Wednesday. Certainly that has a lot of bearing on one of the large secular growth themes of the past some time, and that's artificial intelligence. Mark, path of least resistance kind of seems still to be higher. The soft landing narrative pretty much still in place with looming Fed rate cuts and favorable flow dynamics, which we'll talk a little bit more about later on. Nothing on the U.S. economic calendar. Again, today, Wednesday, though, brings the annual payrolls benchmark revision and the July minutes release. Thursday, the highlight will certainly be initial claims and flash PMIs, as well as existing home sales.
Hey, Luke, Bill from Philadelphia here. Calling about GitLab, ticker symbol GTLB. It's an all-in-one DevOps platform, and was wondering if you guys thought that it would be a good buy at this point, or if it would be a good buy at all, actually. Wanted to get your thoughts on it, and love what you guys do. Thanks so much.
Well, taking a look at GitLab, GTLB is the ticker. It is a DevOps company, like the caller said, and what it is trying to do is compete with Microsoft and compete with other companies in what is a pretty heavily competitive area of the tech space. And the way they're trying to differentiate themselves is through, surprise, surprise, AI integration and their more extensive platform features that are more customizable than maybe a broader suite company like Microsoft. Now, taking a look right here at their performance relative to the S&P 500, they IPO'd back in October of 2021, and it looks like the pop on the IPO is about 125. It's trading about $46 now, so down, almost 2/3 at this point from where it was right after it IPO'd. And the reason why that is because, their annual revenue growth, it's fallen off. It's trending downwards. Consumers, or rather, their cash flow is flatlined as well. Their profitability is actually getting more and more negative, which is not what we want to see. And even though they have no debt at all whatsoever, which you think, oh, that's great. Well, how are they capitalizing this company? Because they're not making money, right? There's no profits in this company. And the answer is, they're issuing a bunch of shares. They've issued about 20 million shares since their IPO in 2021. And so when we look at this company and we see no debt, we see a lot of share issuances, we see that potentially they're set to have profits for the first time this next fiscal year, maybe not. But either way, their growth is definitely slowing. And now in dollar value terms, sure, it's still growing. But if you look at this rate here, it's slowing down. And so I think the problem with a lot of competitive companies coming into the tech space is tech is one of those things that is without a doubt winner take all. And when you entrench yourself, like a lot of these companies have, like the Microsofts, the Googles, the Apples of the world, have entrenched themselves within their niche, within the tech sector, it's very hard to dethrone them. And so, yes, their net margins, maybe they turn a profit this year, maybe they don't. It still stands to be seen. But even with that, I think making $1 here, $1 there, doesn't matter much if you're not growing. And so their price to book, they're currently trading at 13 times price to book for no profits. They're trading at 87 times cash flow. So although it's fallen off pretty precipitously since 2021 when it IPO'd, I still don't think this is a fair price. And that's because there's really no growth here. Maybe they'll turn it around. Maybe they won't. But certainly you can keep an eye on it. But I don't think now is the time to pick it up. Thanks for the call. Let's switch gears and go to Sid from North Carolina, who has a question about CNH. Do you own it or are you looking to buy it?
I just put it in my radar, Luke. Thank you for taking my call.
Yeah.
I'm thinking of adding it because even in the newsletter you discussed that one, though I don't have a data to look at beyond the technicals and other things. But is this the right entry point, or do you have a certain value to go before we pick it up. And I'm looking for a long term, certainly. Thank you for your time.
Yeah, of course. Well, let's take a look. Let's take a look at CNH. It's CNH Industrial. It's an equipment and services company. It develops, manufactures, sells specialized machines. I think we actually recently talked about this name a couple days ago, if I'm not mistaken. Sometimes all these tickers blur together. But back in March, it looks like the company announced a $500 million share buyback. And one thing that I note about this company is they have particularly robust free cash flow. And so, or rather free cash flow growth that is coming into this year. Now, in terms of debt, they have quite a bit of debt. They have $27 billion on a $12 billion market cap company. They pay a dividend of 4.72% is what their dividend yield is at the moment right now. And that dividend's kind of been all over the place. 2.1% back in 2018, down to 80 basis points 2021. Dividends per share, how did that fluctuate? Well, it's been also all over the place. 20 cents 5 years ago, then 0 cents, and then 13 cents. So I wouldn't say they're a stable dividend payer. They have modest short interest out there, but that's not too big of concern. I think what concerns me the most is the fact that, yeah, they have good free cash flow growth, but it was negative the past couple years. Certainly not something that's good. Their net margins are fine. They're in the 8 to 9% range. Their gross margins are pretty low, though. And so efficiency-wise, I'm not sure it's that efficient of a company, and then therefore I would expect it to be at a lower relative price compared to its peers, which it certainly is. It's trading at 7.5 times price to earnings. The industry average, or its average, is 12 times. Price to cash flow, though, still at a 10 times. I think for me, I think it's a company that typically within this industry, you do see these companies taking on a fair amount of debt, but with free cash flow negative the past couple years, cash flow growth declining from where it really peaked out back in 2021. I think that it probably is not a good time to pick this name up because their balance sheet could be a little bit too weighed down at this point in the economic cycle. Thanks for the call. Now, I hope you've been telling your friends about our InvestTalk audio podcast being available in video form on YouTube. And when you go over there and you leave a comment or a question, we like to read them, but we also like to get to them on the show. This one is about Bird Construction. It says, what are your thoughts on Bird Construction? Strong project backlog of projects, 3.4 billion, and rising return on invested capital, which is ROIC. Bird Construction is a construction services company. They work with mining companies, retail companies, commercial companies, multi-tenant residential companies. And, I was looking at this through the break, and frankly, I like what I see. Not a lot of debt, 150 million on a $1.3 billion market cap company. Not a lot of short interest out there. They issued a little bit of shares, but that was back in 2020. Haven't done much since then. Certainly that is pretty good. And so what you're also seeing with this company is some expansion of margins over the past year. Their net margin was around 2%, below 2% down in 2021, which for this type of company, that's typically where it is, the 2 to 4% range. They've expanded it to 2.8, projected to be 3% this year. But most importantly, their revenue has been a pretty big and consistent grower, right? When you're looking at a 5-year revenue growth number, it could all happen in 1 year. It could all happen in 2 years. It could look flat, but that's because it fell off precipitously after 1 year and then it climbed back up. But when you look at it, it's a pretty consistent grower. And their earnings have been upgraded over the past 3 months, something that we certainly like. They pay a dividend, 2.29%. Their dividends per share has been growing as well. It was 39 cents for about 4 years in a row. Last year, 42 cents. This year, set to be 53 cents. And so it's the consistency in growth. It's the consistency in focusing on efficiency. And their strategy through strategic acquisitions has certainly been paying off. So, it's trading right now at price earnings of 10, price to book of about 3.9, a little bit expensive for a construction company. Price to cash flow, don't know what's going on with that figure. I had to dive a little bit more into that because it says 145. Certainly it could be the data is nothing wrong with the data specifically, but periodic reporting can shift numbers. So again, it's very important to dig into what these numbers are and why they are that way. But from everything that I see, I really like this company. It's growing well. It's growing consistently. So I would have to give it thumbs up. Let's go to Peter in Rhode Island, who has a question about RSPU. How can we help you?
Hi, Luke. Thanks for taking my call. So I'm looking at RSPU. Reason being, I feel that utilities are one of the things that people are least likely to cut back spending on, if at all, therefore making it a slightly less risky of a play. And it also allows me to gain a little bit of mid-cap exposure, which I'm currently lacking in my portfolio.
Yeah, no, those are certainly good reasons. I agree with you. One thing to note, though, with utilities is a lot of them are highly regulated. So the profit motive that kind of drives other companies doesn't necessarily exist within the utility space. In fact, the value premium, which a lot of factor funds use, if you look at utilities, it doesn't apply to them. Even though they appear to have value-like characteristics, they don't have value-like returns. So that's something that's important to note in terms of, yeah, people aren't going to cut back, but a lot of them are highly regulated. Now, looking at this fund specifically, it's about 40 basis points. It's the Invesco S&P 500 Equal Weight Utilities ETF. And so rather than taking a market cap-like approach, they're going to pick the names and then they're going to just weight them equally. So what that's going to do is it's going to overweight smaller names, which, typically mid caps, small caps tend to over long horizons outperform large caps. So that's something that I actually like. One other thing that's important to note here, though, is this isn't a pure play utilities ETF. So if you were looking for a pure play utilities ETF, you should probably go elsewhere, and you might find one that maybe even has mid-cap exposure that's a little bit cheaper as well. 40 basis points is kind of expensive for a utility ETF, in my opinion. But what this does is it actually has some weight as well to telecom names. And so when you see the dividend yield being a little bit higher, or maybe you see the price moving kind of in a different way relative to the utilities industry, that's why. So I think it's a perfectly fine ETF. I think that it's going to be very low turnover. It primarily does focus pretty heavily on energy utilities, which is fine. I think getting the diversification there is, again, a good idea. People tend to, in times of economic stress, pack into utilities for the income and for the dynamics of the industry writ large. But again, important to note, if you're looking for a pure play utility ETF, it's not the one. This one's got some telecoms as well. Thanks for the call.
All right. Thank you very much.
Let's play two in a row. This one came in earlier to 888-99-chart.
Hi, Luke and Justin. This is Nick from Texas. I know I'm late on this, but I do want to start off the call by offering my condolences for Steve's family and the InvestTalk family. I always really enjoyed listening to Steve on the podcast. I had an old job where I had a commute an hour and a half each way, and I always would turn this podcast on in the morning. It would always brighten my day, so I want to thank you all for that. The company that I want to talk about is Crexendo. The ticker is CXDO. This is a microcap company. It's 150 million market cap currently. I know there's risk with that, but I see a lot of things I like about this stock. The company has virtually no debt, and they have about 13 million cash on hand. They are growing organically and through an accretive acquisition strategy. They just put out Q2 earnings. The software side of their business is currently growing at a 30% rate, and they're using that free cash flow that they're generating from that to fund their accretive acquisition strategy. The three main competitors on the software side for this, Cisco owns BroadSoft as the number one, then Microsoft owns Metaswitch, and then Crexendo owns NetSapiens. So I just wanted to see your thoughts on this stock, if there's maybe anything you're seeing that I'm not seeing, and I would just love to hear your feedback. Thank you so much. I'm a huge fan of the show, and I look forward to hearing your answer.
Well, first and foremost, I think it's never too late to offer condolences, and certainly we appreciate it. I know that Steve's family appreciates it as well, and it's good to hear that he was such a big part of your life, and that we continue to be such a big part of your life. So I thank you for all of that. Now, looking at the company CXDO, I think you pretty much nailed everything here that I see. Their organic growth is fantastic. We love accretive acquisition strategies. They seem to be doing it very well. They're up 216%. In the past 52 weeks, you hit it on the nail. There's not a lot of debt there. It looks like they are projected to turn a profit for the first time this year. The past 5 years, there were no profits. I think that, or not for the first time, sorry, the first time in 3 years. Rather, they were making money back in 2020. The revenue growth, like I said, great, 34% annualized over the past 5 years, from 11 billion to 53 billion to 53 billion in a 5-year time frame. That's pretty fantastic. So when you look at this, you see the growth. You see that it's heavily valued here. It's a cloud services company, so a lot of cloud businesses, telecommunication cloud companies are going to be rather overvalued, or rather have higher relative valuation multiples compared to a lot of other industries. But it's not crazy expensive. 2.8 on book value, only 20 times on forward-looking price to earnings. It's a small cap. It's a micro cap. And you are correct. There are certainly risks there. But some of the risks are about financing these companies. The other risks are that they can't capture market share. And so when I see not a lot of debt on the balance sheet, when I see cash flow moving the right direction, when I see net margin moving back in the correct direction, and when I see this growth, I like it. And you understand the risk. You clearly understand the risk. You clearly did your research. So I don't have to tell you about the risks inherent to smaller companies. But overall, I like it. CXDO. Thanks for the call. Now, recently, Chinese authorities have made a move that's raised some eyebrows yet again across the global financial community, and they've restricted access to key data on inward investment. And so this decision comes at a pretty crucial time, as international investors have been pulling significant amounts of money out of China's stock market. Starting this Monday, daily data on net investment flows from foreign funds into mainland Chinese stocks, known as northbound trades through what's called the Hong Kong Stock Connect, is no longer available on a daily basis. Moving forward, the information will only be released quarterly, marking a dramatic reduction in transparency, which could have pretty broad implications for global investors. A lot of large funds have criteria. The one that I used to work for had criteria for what types of markets they're allowed to invest in, related to how easy is it to get capital out, how easy is it to get access to information. So this could certainly be a bad thing for China at a time when their market is trying to get more and more foreign investment. The trend that I am talking about here was the start of June. More than 12 billion has been withdrawn from mainland China. And so this reverses earlier inflows, which analysts suggest were driven by the offshore arms of state-backed institutions in the first place. So this trend continues. 2024 might actually be recorded as the first year of net equity outflows from China since Stock Connect was put in place in 2014. And so why does this matter? Well, transparency is crucial in maintaining investor confidence. If investors are left in the dark, it makes it harder to justify entering the market at all. And this isn't the first time Chinese authorities have restricted access to potentially sensitive economic data. Last year, regulations were tightened around the display of mutual fund valuations and the publication of youth unemployment figures, especially, and not coincidentally, as these numbers were reaching record highs. Moreover, to stabilize the markets, Beijing has, as I said at the top of the show, resorted to window guidance, a form of private instruction advising domestic financial institutions against net selling of stock on certain times of the day and certain days of the month. Such measures, while aimed at shoring up market confidence amidst a slowing economy, tend to do the exact opposite. They've decreased liquidity and reduced trading volumes in the A-share market. So what's next? Well, current trends suggest we might see the first annual outflow, like I said, from China A-shares. That certainly is not something that China would like to see. And the broader implications of reduced data transparency and continued regulatory interventions remain a concern for everybody. After all, transparency is one of the most important pillars when investing in an international market. Let's answer another question that came in on our InvestTalk YouTube channel. It says, I'm looking at getting into a home builder and have narrowed it down to PHM and TOL. Which one do you like? Well, let's just take a look at one so we can get to everybody's question. Let's take a look at PHM, PulteGroup. And PHM is a home building business. It's going to take a second to load because sometimes computers are not cooperative, but there it is. PHM is a home building business, and they are involved in mortgage banking, title and insurance brokerage operations, and primarily focuses in the home building sector, but also the financing of home purchases as well. Now, their sales have grown pretty well over the past 5 years at a 10% clip, very solid. Gross margins sit at around 30%. Pretty good as well. Net margins have increased a lot from 9% back in 2019, projected to be 16% this year. Now, they've issued a fair bit of shares over the past 5 years. They've issued about almost 50% of what they had before in the past 5 years. Oh, I'm sorry. This did not pull up. I take that back. They have not issued very many shares. So what does their cash flow look like? Well, their free cash flow has been improving in the past 3 years, certainly $578 million to $2.1 billion, $1.9 billion projected this year. Their dividend that they pay has been steadily improving over the past 5 years. 38 cents per share, up each year, 45, 50, 57, 61, projected to be 78 cents this year. That gives them a dividend yield of just under 1%, which is modest but good. They've actually been buying back shares, which is the opposite of what I said, and that is something that we certainly like. 280 million shares back in 2020, now down to 24 million shares this year. Their debt levels, modest, $2.5 billion worth of debt on a $25 billion market cap company. Not a lot of short interest out there. Everything I'm seeing looks pretty solid. Unfortunately, we don't have enough time to get into the other company, but as a solo company here, PHM, just on PHM, which trades at a 9 times forward-looking earnings and 2.3 times price to book, going to give it the thumbs up. Let's go ahead and play another question that came in earlier. This one on Rick.
Hello, my question is regarding RCI Holdings, ticker RIC. I would like to know the prospects for a long-term hold. Is this still a worthwhile hold? And if it is it time to scoop more up? My average cost basis is at 58, currently sitting at 3% allocation of my overall. I have room to pick up more. Memory serves me, you liked the moat. Would this be a good buy at these levels, or is the thesis broken? Thank you, InvestTalk, always giving the people what they want. I will hang up and listen.
Well, I'm glad we can give the people what they want. So let's talk about Rick, RCI Hospitality Holdings, and its same-store sales have been pretty bad, or its revenue from same businesses has been pretty bad, down 30% in the most recent quarterly update. Taking a look at their debt levels, pretty modest, $278 million on a $402 million market cap company, but their share price has fallen pretty precipitously over the past 52 weeks, down 33%. And so what they do is they engage in the provision of live adult entertainment and dining experience. I think they're trying to break into the casino business as well, but 73% of its revenue comes from nightclubs. 73% of its revenue comes from nightclubs. And so people are paring back on some of their spending. I imagine nightclubs are going to be the first place where they're going to pull back. Now, with that being said, I think that this is a company that is going to be certainly tied to the cyclical nature of the business that it's in. And the market agrees. There's 10, almost 11% short interest out there. And so if it's 3% of your portfolio, I probably wouldn't be picking any more up of it right now. Its valuation looks fine. It's trading at 1.5 times. Again, the fact that it doesn't have any debt or much debt to speak of in terms of the money that it is making, its times interest earned is only 4.23%. So they're not, or 4.23 times. So they're not overly levered. And even with the falling revenue, their margins are still pretty good. This year, they're supposed to contract to about 4%, but it was 10% last year, 17% the year before. Again, I think a lot of this has to do with the cyclicality of the business, and their balance sheet is positioned in a way that it could withstand that, but it might have another rough 6 months. So I wouldn't necessarily say sell it. It's down another 3% today. It's been down 10% in the past 3 months. It doesn't look to me like, from a technical perspective, that maybe it could slip down lower. You might be able to even pick it up at about 40. So until you see some more consolidation and finding some support, I wouldn't pick it up. I wouldn't sell it, but I would certainly keep it on my watch list. Thanks for the call. 3 in a row. Let's do it. This one on STRL.
I wanted to get your opinion on a company. I was looking at some infrastructure small cap companies, and I came across Sterling Infrastructure, ticker symbol STRL. I wonder if you could take a look at the financials for me and let me know if now is a good buy point, or if not, what would be. Thank you very much. Have a good day.
So Sterling Infrastructure is a construction infrastructure solutions company. $3.4 billion market cap. So it is, in fact, a small cap. $399 million in debt. Certainly not much there. They pay no dividend. They got about 6% short interest. And in the past 5 years, they've issued quite a bit of shares, from 26 million shares outstanding up to 31. Now, in that time, their cash flow steadily improving. Their margins have been pretty consistent, though expanding generally from 2.4% up to 7% last year, 9.2% this year. Let's look at the growth. 13% over the past 5 years, annualized, trading at a forward-looking price to earnings of 19 times. I think that, again, this is a business where you want to talk about the cyclicality of things. With rates dropping, that'll certainly be a better harbinger for business moving forward. But where it looks to me to be on a technical perspective, I wouldn't pick anything up right here. It looks like it has some pretty solid support at the 100 level, though, but looks like there's some downward bearish consolidation. Not a time to sell, certainly not a time to buy anymore at this point. Thanks for the call. Let's go to Sammy in San Francisco. Has a question about CrowdStrike.
Yeah, thanks, Luke, for taking my call.
Yeah, of course.
Well, I wanted to get your opinion on CrowdStrike. Looks like it has turned the corner, starting to bounce back up again. Do you think it's a good time to get in or not?
I think the dynamics that make CrowdStrike a risky investment still exist. That primarily being that they had a massive, I believe everybody probably remembers this, massive mess up that crippled everybody everywhere. Except for, I mentioned it before, jokingly, Southwest, because they use Windows 92. If I am a CTO of a company, I am very weary of renewing my contract with CrowdStrike, who could directly lead to me being fired should issues like this keep happening. And so, sure, the chart looks like it's improving a little bit. Maybe it turned a corner. I mean, frankly, it's been moving upward for less than 2 weeks at this point, as the market has overall. But the issues that are there are still there. And it's still trading at 61 times its forward-looking earnings. It's still trading at 53 times its cash flow. Still trading at 30 times its book value. So could it keep moving up? I always say this. Could it keep moving up? Yeah, it could keep moving up. None of us has a crystal ball. But our job as investors is to make critical decisions based upon the information in front of us, and the risks that existed for CrowdStrike when it was headed downward still exist today. Thanks for the call. Now, before we head off for the day, let's touch on one more topic, and that is about flows. And primarily what I'm talking about is equity flows, in spite of, let's say, some issues 2 weeks ago. And so recent market trends have shown a significant rebound in investor confidence, with a notable increase in equity holdings following a sharp decline in early August. Last week, investors substantially boosted their exposure across really a lot of sectors and a lot of products: index options, mega cap, tech, cyclicals, defensives, recovering fully from the previous week's downward movement. Now, this resurgence in market activity comes after a period of heightened anxiety where fears of U.S. recession led to significant sell-offs, including a dramatic drop in the Tokyo Stock Exchange, really triggered mostly by market structure. Now, this situation in Japan accelerated an unwind of the yen carry trade, which affects leverage within the United States as well, and resulted in one of the worst sell-offs since 1987. However, the recovery was pretty swift and pretty robust. U.S. equity markets seem to have, I would say, fully recuperated within just 2 weeks. Last week's surge in global equity markets, described as the best weekly performance since November, was supported by this calming of volatility and encouraging U.S. economic indicators, and overall diminishing immediate fear of an economic slowdown. Now, the rebound is particularly noteworthy, I would say, because it comes just ahead, or rather it's coming just ahead of a meeting in Jackson Hole, which happens every year, and it's an annual meeting of central bankers from all around the world. They convene, they talk, they plan, who knows what they do. But the market takes a lot of cues from things that are said at this meeting. Now, the current federal funds rate now reflects an expectation of 4 quarter-point rate cuts by the Federal Reserve by year's end, which is certainly a more dovish stance, more optimistic stance compared to the emergency rate cut that everybody on financial Twitter was calling for in the wake of a 20 basis point increase in the unemployment rate just a few weeks ago. In fact, the sentiment of credit markets is also notably far more bullish. Bank of America's survey indicated that 3/4 of respondents now anticipate U.S. inflation to decelerate without leading to a recession, marking the highest confidence level in a soft landing scenario ever recorded in such surveys. And so the primary concern for investors have shifted slightly. Geopolitics and potential central bank policy errors are still the dominant worries. But let this serve as a reminder, another stark reminder, that when people get scared, when people react, they can overcorrect. And that's what happened. You had a huge market sell-off because people were overreacting. And so for us, it's best to keep that long-term focus, keep that discipline, and invest wherever we can. Now, I'm Luke Guerrero, and this completes another InvestTalk podcast. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads on iTunes, Spotify, Google Play, maybe some other places, wherever you get your podcasts. And please be sure whenever you can to leave us a rate and a review. Or check us out on the InvestTalk, maybe not even or, maybe and check us out on the InvestTalk YouTube channel. That's InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.